What is going on, traders? So we are witnessing the worst money supply contraction since the 1929 Great Depression. And it's also apt that we talk about the US interest rate hikes and the pace of the hikes, especially on the eve of the FOMC decision, where it is likely that Jerome Powell is going to do another 25 basis points. But these are the fastest rate hikes in history, even faster than the rate hikes that we saw in the 80s when the Fed funds rate reached all the way up to 20%. And we should also highlight that this is the biggest net short position on the S&P 500 futures since 2011, which was the last bear market before the pandemic shenanigans. We'll also get into the FOMC decision. We saw that in the wake of another bank collapse, the second largest bank collapse in US history, which was FRC Bank, bought up by JP Morgan. Now, the possibility of a 25 basis point rate hike dropped from 93% to 85%, although I still think Jerome Powell is going to hike. And since we are a stock market channel, obviously we will follow what is going on in the market. Right now, the market hasn't really moved for 5 weeks, trading in a very tight range. Now, we'll also be giving you a few trade ideas, especially on the 2-year Treasury note futures that you guys know we routinely trade that, especially around decisions that might affect interest rates, because the short end of the interest rate curve is what is affected normally when policies are set in place. A lot of people talk about the 10-year or the long-term treasuries, or they talk about TLT, for instance, but that is a misconception. The short end of the curve is what is directly affected by policy decisions. So we will get into all of that. But before we jump in, make sure you follow me on Twitter and Instagram, where I post daily trading and finance content for free every single day. You definitely want to follow me on those 2 platforms. And we just brought back monthly memberships to the Trading Academy. Use the coupon code below because it is limited and will expire soon. And that will get you about 30% off. Let's get right into it. All right, so let's talk about the money supply and why this is important both for the economy and the market. But first, let's talk about what the money supply is. So in general, the money supply is just the availability of all of the cash in the system. It's a measure of the money that includes cash, checking deposits, and non-cash assets that can easily be converted into cash. And as you can see from this chart, this is actually from the actual Federal Reserve and the US Census Bureau. You can see that we are now at minus 4% in terms of a contraction. That is the greatest since the Great Freaking Depression. That is more than the 2008 financial crisis, when we didn't even hit zero. As a matter of fact, the last time we hit zero was in 1960. And again, the last time we were negative was in the Great Depression. Now, we've talked about how a credit crunch could be one of the harmful results of the Fed raising rates so aggressively and breaking the banking system, where we are now seeing bank runs. Obviously, banks are going to be more reluctant to lend, right? However, if we take a look at what is going on with the bank lending, this is from a Twitter account called Lynn Alden. Great follow for macro. You should follow that. But she says basically that the bank lending hasn't really contracted yet, and it's actually consolidating. So what the reduction that we are seeing, or the contraction that we are seeing in the money supply, isn't really because of the fact that there is a contraction in lending. There has been a slowdown or a consolidation in lending, but not yet a contraction. Now, it makes sense that there is a reduction in the money supply due to a reduction in lending or a consolidation in lending. But again, that is a very tiny piece of the puzzle. It most likely has to do with quantitative tightening in conjunction with what is going on with the reverse repo facility. Now, the Fed's reverse repo facility is a way to control overnight interest rates and liquidity. And basically what happened, without getting into it too much, but it is important to know why the money supply is reducing. Banks that have a reserve in cash give that cash up to the Fed. The Fed gives them securities, thereby taking liquidity out of the system overnight. And then the next day, the banks give those securities back and take the cash back, earning an interest rate. Now, because money market accounts are paying a high rate, we are seeing a wave of depositors deposit money into money markets and really ignoring the normal bank accounts. So the institutions that are offering these money market accounts, they are taking that cash and using the Fed's reverse repo to earn an interest on that money to the tune of $2.2 trillion. Now, why is this an issue? Well, it is an issue because they are effectively draining funds from the banking system. And where there is already a risk of a credit crunch, meaning a reluctance to lend out that money and make the economy work, this money could otherwise be invested or lent out. However, banks are using the reverse repo and the high rate that it currently pays, there haven't been any changes really in the reverse repo rate or any of the or the policies surrounding it as a result of the bank runs, as a result of the interest rate hikes, etc. So they are using that facility logically because that facility is still paying a high rate. And so banks have no incentive to lend that money out in order to stimulate the economy. Now, you might be asking yourself, well, isn't that the point? Doesn't the Fed want to reduce liquidity in the system and hopefully thereby reducing prices and curbing inflation? Well, yes. They want to have their cake and eat it too. That is what a soft landing is. They're hoping that they can aggressively raise rates. They're hoping that they can aggressively do quantitative tightening, which is the other piece of this puzzle. The other reason that the M2 money supply is getting drained is because they are also in conjunction selling assets off of their balance sheet and doing quantitative tightening. But they're hoping that they can do all of these things without breaking any parts of the financial system or breaking it too much, and hopefully also curbing unemployment, right? They're hoping that unemployment doesn't spike, even though secretly they know it will. And they're hoping that they can achieve a soft landing, raising rates, taking money out of the system without disrupting the economy too much. We all know that this is just a fantasy land. That's not how things work, especially when we are dealing with the fastest paced rate hikes in history. So things are breaking. Obviously, we have a complete contraction of the money supply. We are seeing bank runs and a lack of confidence in banking. So a reduction, a heavy reduction in deposits into banks. And we are on the cusp of a potential credit crunch. And we haven't really seen the extent of the layoffs. As of the time of this recording, we do have unemployment being reported on Friday, May 5th. So the Fed is hoping that they can raise rates aggressively without breaking anything and somehow maintain a stimulated economy. That is not the case. When you raise rates aggressively, especially as aggressive as this, things are going to start breaking, and we are now finally seeing things break in the form of the disruptions in the banking system, as well as the contraction now in the M2 money supply. And as I mentioned, we are also seeing the biggest net short position in S&P 500 futures. These are not options. These are not the what we look at generally, which is the put-call ratio. These are actually futures, which to me hold a more significant weight than options do. When we tend to see a high put call ratio, especially ratios over 1, that actually usually signifies the bottom of a market, just like we saw in March 2020 and just like we saw at the end of 2022, which was the start of the run up that we see up until today. However, if we take a look at the weekly chart of the S&P 500, you will see that we have not moved in 5 weeks. This is the weekly chart. And if we take the last 5 weeks, we're basically trading in this tiny box here. And we haven't really moved because the market wanted to see what the results of earnings were. And earnings, honestly, like as of now, they don't look so bad. Obviously, we have Apple earnings being reported on Thursday, May 4th, and Apple being the largest company in the world can sway the entire market. But that is the reason that I sold my stocks in February, which is the same level that we're at now, right? The stocks that I bought at the end of 2022, I was okay taking profits in February because we have been at this resistance level for over a year now. The market has actually been trading in a very sideways fashion. Meanwhile, we get bears and bulls celebrating prematurely with every trough and every peak, but the market hasn't really made any significant strides. I will give you my trades towards the end of the video, but for me, as I said, as I've been saying all along, I'm not overly bearish or overly bullish. I do think the market is going to signal an end to the mayhem sooner than the economy is and sooner than the bond market is. The stock market always bottoms before a recession is over, but I don't think we've seen the worst yet as it relates to the effect that the interest rates are going to have on the economy. So I would not be surprised to revisit the 3,800 level or potentially the 3,600 level on the S&P 500. As we've seen now this yearly sideways trading pattern, it could get ugly for the long term. It could get ugly for another year or even multiple years. And by ugly, I mean just this sideways choppiness. Now, if something completely breaks and we get a massive credit event, which a lot of financial analysts are worried about, that the banking disruptions that we see now is just the beginning, and that we will have a credit event in the form of some sort of mass default event that we cannot predict now, whether in the corporate sector or in the in the consumer sector or both, right? But that you cannot raise rate hikes, you cannot raise rates like this at a super fast pace without something else breaking. So depending on the extent of that, it is yet to be seen if we will make new lows past what we saw in October 2022. I think we will need to see unemployment come up so much past, that 4.5% mark. We will need to see earnings actually affected by what's going on in the economy and some sort of mass credit event that causes fear for us to break these October 2022 levels. But I would not be surprised to see 3,800 or 3,600. I just don't see an impetus for really significantly breaking above 4,300, which was the peak that we saw in August 22. So I'll get to a couple of plays towards the end of the video, but let me just talk about what the Fed is expected to do. The Fed is expected to raise rates by 25 basis points. Now, it's interesting that the possibility of a 25 basis point rate hike fell by almost 8% after First Republic Bank folded, the second largest bank fold in history, right? But I still think that the Fed is going to do a 25 basis point rate hike. Now, if we take a look at June, the most likely scenario is that the Fed pauses. So now the market is betting that the Fed does 25 basis points and then pauses in June, and then absolutely no more rate hikes until September, where now the largest possibility is that the Fed actually cuts in September. And I think it's totally plausible that the Fed actually pauses here after a rate hike on Wednesday, May 3rd. I do think that it is plausible that the Fed actually pauses. Now, pausing, is that bullish or bearish? Well, in reality, pausing is actually bearish. It's not bullish. The stock market might see, a spike if the Fed actually announces or hints at a pause. But in the midterm, pausing is actually bearish because it signifies that the Fed is so afraid that they're going to break something and things are starting to get out of hand that they want to pause rates, but they're not going to pause and then cut. They're going to pause and hold them there for months, right? Or potentially even longer. So a pause is really just a holding of destructive rates, and they want to see what else is going to break. Is unemployment going to go up? Are prices finally going to come down? Remember, we are still fighting inflation. And after the rate cut, after we cut rates, that is when you tend to see a recession. This gray bar here is a recession. So, back in 89, after the cuts, we saw a recession. In 2000, after the cuts, we saw a recession. In 2008, after the cuts, we saw a recession. And in my view, it's not going to be different here. That the Fed is going to pause eventually, whether after this month or after June. And then they're going to hold it there for months. And then after the cut is when we will see a recession. So in the very short term, pausing could see a spike in the stock market. We could see a little spike in the stock market, but essentially it is bearish both for the economy and historically both for the stock market as well. Now, in terms of my plays, and again, if you want access to all of our plays, link is in the description below, including our day trades, including the day trades that we will be implementing on the actual FOMC day itself. But the 2-year note for me has been the easiest trade. It has established this support for 3 months here, and I've just been buying it off support, selling it at resistance, and this time will be no different. Now, if the Fed actually indicates a pause, you can expect the 2-year to shoot up. The 2-year futures, the 2-year yield will decline if the Fed signals a pause, because if they're signaling that they're not going to raise rates anymore, then bond investors are going to want to lock up all of that yield since the 2-year is now back above 4%. They're not going to want that yield to escape, so they're going to pour into the 2-year most likely, which would cause the yield to drop and cause the futures to skyrocket. So for me, although we could have bought off of this right here, I am waiting actually for the Fed to signal, and then I will make a trade on the 2-year note futures. The ticker symbol is ZT. And then I'll also be monitoring the indices, likely futures, during the time of the FOMC. Make sure that you are actually, subscribed to this so that you get a notification that I'm going live, because I go live every single FOMC event and CPI. So I will be going live, and I'm not going to pick directionally from here what I think is going to happen on the FOMC day, because regardless of whether you're a bull or a bear on FOMC day, you will get a mini heart attack because we know how the prices spike up and down. So even regardless of what position you had, you will sustain a heart attack. So I usually wait for Powell to stop speaking and for the policy to actually be released before taking a trade and seeing where the market wants to trend. If the Fed does announce a pause, I do expect us to hit this 430 level or near there on the SPY. At which point I might sell a credit call spread there, a credit call vertical spread on the SPY. If the Fed doesn't announce a pause, which is very likely that the Fed can easily come out and say, you know, we're doing a 25 basis point rate hike. I don't know why you guys keep talking about a pause, no pause on the horizon. Then I do think that the S&P 500 can actually see a fall back to these support levels below 400. Anyway, traders, that is it for this video. Leave it in the comment section below. Let me know if you got something out of this video. Let me know what you think the Fed is going to do, whether you think we're going to be in a recession, how ugly it'll be. Let me know what you think of the M2 money supply. Let me know what you think of the actual banking industry and whether we are just getting started or whether the worst is behind us. Would love to hear from you guys. Sign up if you want access to all of our trades, if you want access to the chat with thousands of traders talking about strategy all day, every day. Link is in the description below. Make sure that you subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.